You might assume that professional fund managers, armed with teams of analysts and hefty research budgets, have an unassailable edge. And yes, they're smart and hardworking. But the truth is, mutual funds come with structural and behavioral constraints that often hold them back. First, these managers oversee enormous pools of other people's money. That kind of scale brings heavy mandates. They must spread bets across sectors, avoid concentrating too much in a single stock, and meet diversification rules. When you're managing billions, every significant trade moves the market, eroding potential gains. Contrast that with the individual investor who can nimbly enter or exit a position without influencing prices. Second, without their own capital on the line, managers can lack the same intensity of motivation. Legendary names like Peter Lynch or Warren Buffett are the exception. For most, continuous board reviews and compliance checks slow decision-making. Breathless burnout is common, and once a fund reaches gargantuan size, speed and flexibility vanish. Finally, today's retail investors enjoy an unprecedented information advantage. Online forums, regulatory filings, and collaborative research platforms allow you to spot underappreciated opportunities in real time. You can drill down on niche sectors, connect with fellow investors, and act on insights faster than ever before. In this new era, agility and passion often trump mere resources. Having the freedom to act quickly is only part of the equation. The foundation of a solid portfolio is exposure to the long-term growth engine of the U.S. economy, technology. That's why a NASDAQ index fund deserves a central role. First, the U.S. economy stands out for its resilient fundamentals. Consumer spending remains robust, corporate profits continue to grow, and fiscal and monetary authorities can swiftly adjust policies when shocks hit. Political debates might seem chaotic, but our system of checks and balances prevents radical policy swings. Second, America's innovation ecosystem is unrivaled. Whether it's venture capital fueling startups, world-class universities driving breakthroughs, or a legal framework that fiercely protects intellectual property, this environment breeds rapid technological advances. No other region matches the pace of innovation you find in Silicon Valley, Boston, or Austin. Third, breakthroughs are arriving at a dizzying pace. Robotaxis are already logging millions of driverless miles. AI agents are accelerating everything from coding to drug discovery, and commercial space ventures are opening entirely new revenue streams. Together, these innovations form the backbone of the NASDAQ. Finally, picking individual tech stocks is notoriously difficult. By investing in a broad NASDAQ index fund, you capture the collective upside of hundreds of growth leaders while mitigating the risk of being wrong on any single name. Over decades, this diversified approach has outperformed most active managers, without the guesswork. But no strategy is complete without sound risk management. Let's cover 4 core principles. First, never commit your entire capital at once. Market pullbacks of 10–20% are routine. By staggering your entries, sometimes called dollar cost averaging, you buy more shares when prices dip and fewer when they rise, smoothing your average cost over time. Second, prepare for drawdowns. Define clear rules in advance. For example, trimming a position if it falls more than 15%, or using options to hedge against steep declines. These aren't about eliminating risk completely, they're about limiting catastrophic losses. Third, master your emotions. Greed and fear lead to impulsive trades. Set specific buy and sell triggers, stick to your stop-loss levels, and don't let headlines dictate your moves. A calm, disciplined mindset often makes the difference between success and frustration. Finally, think of two-way diversification, across sectors and across time. You might use a NASDAQ index fund for broad tech exposure, then smooth the ride by mixing an upfront stake with regular contributions. Beyond reactive risk controls, proactive steps can further stabilize your journey. Start with continuous learning. Set aside regular time for macroeconomic updates, Fed announcements, GDP releases, and corporate earnings, and complement that with deep dives into a handful of sectors you care about. Next, keep an eye on a few key indicators without micromanaging: PE ratios, inflation, and unemployment rate, to name a few, and resist the urge to chase every real-time blip. Cultivate emotional resilience. Techniques like pre-commitment, writing down your rationale before major trades, or even short breaks from market news can prevent you from being swept up in panic or exuberance. Finally, engage with the policy environment. Whether it's SEC rule proposals or tax law changes, early awareness helps you anticipate sector rotations and regulatory headwinds. Subscribing to official alerts and participating in public comment periods can give you an informational edge. You might think technical analysis is the domain of day traders, but even long-term investors can benefit from chart-based signals. For instance, simple moving average crossovers, like the 50-day over the 200-day, help confirm that a trend is intact. Relative Strength Index, RSI, can offer an early warning of potential momentum exhaustion before a possible reversal. These tools don't replace fundamental research, but they offer objective entry and exit points. Moreover, having clear technical guardrails, such as exiting when a key support level breaks, removes guesswork and keeps emotions in check. Studies show that blending systematic technical rules with fundamental filters can improve risk-adjusted returns over decades. In essence, technical analysis provides a disciplined framework that complements your long-term thesis. Today, we've shown that individual investors, armed with agility, information, and discipline, can outshine fund managers. By anchoring in a NASDAQ index fund, applying solid risk controls, taking proactive steps, and using technical signals as guardrails, you're well-positioned to navigate market cycles. Thank you for watching. If you found this helpful, please like, subscribe, and share. And drop your questions in the comments. See you next time.